Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be taking a look at something we haven't done for a while, so I thought it'd be a really kind of cool way to, kind of go back over again, and that's going through the candle-by-candle analysis on a specific market. In this case, it's the S&P. Now, the reason I'm choosing the index markets as a whole is because today was very, very slow. And a lot of times, when you have those types of situations, you're going to have a lot of folks that are saying, oh, today's just noise. It's just noise. It's just a bunch of back and forth, nothing but that's not true. If you look at the volume hasn't changed much, so obviously there is a lot of interest on each and every candle, just like there always is. And that creates a very interesting scenario, because a lot of folks who, look at it and say, oh, it's just noise, blah, 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 in all honesty, they probably just don't read that much into price action or understand the importance of really calm mornings like this to give you an idea of what's happening. So looking at the S&P for today, and now of course we never want to cheat, so let's set the right side margin to a lot bigger. Let's go to 750, and that will cut it off. Oop, and the numbers let me cheat anyway, so let me delete those two. There we go. So we're starting off the day right here, okay? Now, we start off the day with a gap down. This gap down is inside of yesterday's price action, which means that that is inside yesterday. So yesterday's low, yesterday's high, price is within that. It's actually right about smack in the middle of it, 50%. And what do we get on the very first 5-minute bar here? Well, we get a doji. Ooh. Everybody's favorite, starting off the day with a doji, said nobody ever. The S&P started off with a really weak start. But, again, the volume is still there. The market is still pushing around in volume, even though it didn't move anywhere. And we can see that if we go down to the volume indicator. Let's just add the volume at the bottom. And you can see, right? Look at the volume here. The volume here was equal, actually more than yesterday's first candle. So there's more volume coming in, and we get a doji, which further proves the point of what I was saying. Just because the market's not necessarily moving doesn't mean it's noise. Otherwise, there wouldn't be 32,000 contracts traded. Noise, that doesn't happen, right? People don't just flop back and forth millions and millions of dollars because, it's just noise. So something is definitely happening here, okay? But we're not seeing that follow-through movement. Right out of the gates, we're looking at a doji to start the day, and this gives us a clue that, hey, this is only the first candle of the day, but it might be a clue that we're going into a range. So we want to kind of look for any levels of support that may be coming in that could cause potential range bounces, range fades, etc. So what do we have? Well, let's look back at yesterday. Yesterday we have a level of resistance here. That's the previous swing low. We gapped underneath that. We have the strength move to the upside here, and that creates a level of support right there. We also have a strong leg up, which creates another level of support down here. We, of course, have the close. I'm going to mark that in orange. And then we have the previous swing high. Those are all the major levels of support that stand out right now. Now, you could argue a minor level of support right down here on this swing low, and given a range, it might be good enough, but chances are more folks are going to be focusing on the bigger one because that's where, well, that big move up happened. So let's mark all these up here. We'll get a line right there. And I'll try to do this as neatly as possible. Let's make these nice and thick. Let's go for a 5 thickness. There we go. So we have supports. Again, questionable support here. We also have supports here, and we have support. Work with me. There we go, right there. In terms of resistance, we can take this and move it up here, and we'll just change it to red. There we go. I'll use the same red color for the gap fill. Good enough. Then we have resistance up here. These are going to be the levels that I'm looking at and saying, okay, well, the market is potentially starting out in a range. I need to find something that might be causing support, might be causing resistance, and just kind of ping-ponging the market back and forth. It's only the first candle of the day. A lot can happen on the second and third. So we go into the second candle, a bear bar. But what's the big thing here, right? The sellers tried pushing the market down, but notice they were not able to close underneath the lows of that bottom, right? The first candle of the day, they couldn't even close underneath it, and it rejected back up. And this was actually an engulfing bar, right? It was above the high and below the low of that first doji candle. That's almost like resetting the day and saying, well, you know what? Yeah, the first candle doesn't really matter much. Let's look at the second. Now, in context, we have a doji and a weak bear bar. We're gaining confidence that this is going to be a non-trending environment, but we don't have a clear sign yet. We are holding support off of that rally to the upside, but there's not really enough to put a general bias on there. There may be buyers who are buying this on that failed attempted breakdown, but basically we've kind of reset the day and we're back to square one with the first candle of the day because it engulfed. So we'll have to wait. We do see the buyers coming in and defending that level of support and pushing back up. Now, interesting thought here is that, well, now we have a potential of a mean reversion. Now, if you're not familiar with what I'm talking about, go back into some of the videos, and I'll post the link in the description, that covers the VWAP indicator and mean reversions. And if you look at the VWAP, it is smack in the middle, right? So we are smack in the middle. The volume is dead center, and we're not getting any conviction one side or another. Buyers did end up buying the lows. I was not part of them because I just don't see enough conviction yet to prove anything. But now we have 3 candles, and this is the first bar that is closed on its highs. That's a very strong candle. And this is where we have to see, okay, we have our first strong candle of the day. We just came off the backs of a doji and a weak breakdown. We now have a very strong bull bar. What are the buyers or sellers going to do about it? And this is where things start getting interesting, so we want to pay attention to this. Because remember, we still have that swing low level of resistance, and a lot of times on an inside day, we already know it's a range that is definitely an area of interest. And some might even place a limit order to sell there to try to get in and fade that move. And given the context so far, can't really say that I would blame them. I'm not going to talk about where I would place trades and all that, but it's good to know where those traders are coming in. And there will be sellers on a retest of that swing low. Likely, at least. A good, I would say probably 65-70% chance likelihood sellers there. It hits it to the tick and turns right back down again, and there's that mean reversion, right? So the mean reversion fading off of the highs, fading levels of structure, and it's right back down to VWAP once again. Pretty straightforward. Now, this is where we want to pay really close attention because now we have confirmation that this is a range. The buyers failed the strong breakout. The sellers failed the strong breakout. We are now looking to fade everything. Buyers will be at the lows. Sellers will be at the highs. I'll do it like this because that is the zone that has disproven everything that's happened so far. Started off the day with a doji. Tried getting a bear breakdown. Failed. Tried getting a bull breakout. Failed. We're in a range. Pretty much dead and sealed right there. We're in a range. So now we're looking to fade. Buyers will be at the lows, looking for a bounce back. We already know that there is structural support there, and there is a little bit of support just below that for them to maybe get a couple extra. We come down, we hit that same level of support. Buyers will be buying into the lows. I don't know if they were filled or not. That's a to-the-tick test. But if they were filled, buyers are probably pretty happy, and they're looking for a mean reversion back up again, probably just for a standard 4-tick scalp like you would normally see on the S&P. But they may be gunning for a retest of the highs, right? We do know that these buyers that tried to buy into this bull bar are probably stuck, right? They're a little bit nervous. So what does that mean? Well, buyers bought in thinking, okay, here's the gap fill. We're going to go flying higher. We're going to fill the gap. And then from there, I don't care because I already made all my money. So we know that buyers bought into that. And where are their stops? Their stops are going to be below the lows. Those stops have not been triggered yet. So they are not stopped out. And that is a very important piece of information because we know that buyers are still in. If it triggers them short, that would potentially allow a sell move to the downside, right? For a quick little scalp. Might only be a 2-tick scalp, but a potential scalp on all of those buyers getting stopped out. So we need to pay very, very close attention to the lows. If that low breaks, there's a problem. Okay, we know that buyers are in. More buyers probably bought into this low trying to get a push back up. And now we know that buyers who did get in here on bar 3, they're going to be looking to try to get out. They were dead wrong. It went all the way down to their stop. They missed the stop by a tick. I don't know about you, but if a market comes all the way down to my stop and then gives me a chance to get out at break even or lighten the load, maybe take 80% of my contracts off, you better believe I'm going to take that option. So here we go, right? Let's keep going. We form a micro double bottom and almost a micro double top. Almost a micro double top. So obviously there's a lot of support here. And again, the buyers do not want to see this low broken. And the sellers do, right? They want that breakout move to the downside. So nothing really of interest yet, but I have to assume that now we know sellers got in here, right? So not only do we know buyers are here, but sellers are also coming in underneath the bear bar, and the sellers who came in underneath that bear bar expecting that punch through the lows, they did not get it. So now we have both sides trapped. We have the buyers thinking they're wrong. We have the sellers starting to get a little bit nervous that they're wrong. We're running into some issues here. In terms of the way that I look at it, what I want to see is a retest of this, because these were the first traders that were trapped in, right? Those buyers above bar 3, those are the ones that I want to pay attention to, because that is where a lot of the majority of the buyers probably got in. So that's really what I'm looking for, and good, again, really good odds that there are sellers waiting right there trying to get it to push back down. So I will put a level of resistance there that is certainly a level of interest. We get a pop-up, it tests that break-even point, and even better, it hits it to the tick and fades off. Now, the reason I like that more than if it would have filled it is because now we have buyers that are nervous. Put yourself in the shoes of a buyer that bought there, right? You bought there, it meant up in your favor, right? It was up at one point in time until it hit that swing and then collapsed all the way down to one tick away from your stop. Now you're thinking, crap, you know, what am I supposed to do now? I'm going to try to get out of break-even if it comes back. Comes up and hits your break-even point and does not fill your limit order because it's the S&P. Good luck getting filled to the tick. Now what, right? Well, the candle fades all the way back down and closes halfway into itself. There are going to be a lot of buyers who are thinking, oh, no, it didn't get me at break-even. Now I'm stuck. Right? I gave it a chance to come back to break even. If this thing turns around at all, I am out, right? I'm cutting it. I do not want it anymore. And that means that the low of this candle is a huge line in the sand. If that low breaks, that is a problem, right? All of the buyers who've been buying in, they try to get out of break even, unsuccessful, comes back down, they're going to hit the exits, and they do not want it. Now, the buyers and sellers, this is where the fist fight starts coming in on quite a level of interest, honestly. And again, that goes to show you why there's so much volume behind the scenes and why this isn't just noise. There's a lot happening here. And we know that, well, sellers are likely stuck, buyers are likely stuck, and they both feel like they're getting screwed. And the buyers probably more so than the sellers. Now, as this starts rallying higher, the sellers who sold bar 4 are now realizing, okay, maybe I don't want this trade anymore, okay? So this is where a level of interest starts coming in there as well, right? So the buyers who bought, I'm sorry, the sellers who shorted bar 4, they are going to be looking for a reason to exit as well, right? So we have a little bit of a situation. These are the break-even buyers that tried buying bar 3. These are the break-even sellers that tried to sell bar 4. Both of those are lines in the sand. Now, the buyers who did buy bar 3, if it can come back up, you better believe they're going to hit the exits, because it's kind of like a, oh, man, thank you, market. Just get me out of this thing. I don't want it anymore. Which means that if you're a short seller, or you're looking to get in at a slightly better price of your original sell below bar 4, or maybe you're looking for a scalp, a fill of that level becomes very, very important. So looking for sellers to come in here, both buyers exiting their original position out of fear and sellers who realize that fear. They may still be short from bar 4, but that gives them a really good reason to want to sell more to try to get it to roll back over. Okay? So if we can come up and we can fill that level, that's where a lot of limit sells are going to be, both buyers exiting and new sellers. There's a limit fill, right? So it ticks through it, and all of the buyers were finally given a bone, right? They finally got a bone thrown to them, and they've been able to exit. But along with them exiting, we also know that a bunch of sellers jumped in and they looked for a scalp back to the downside. Beautiful play from the sellers. And if the sellers were in short from here and they entered in another short here, their break-even point now would be right here. It's right in the middle. So this is actually profitable territory for the sellers who sold that low. And a lot of times what you'll end up seeing is sellers will try to get back down to their original entry point to exit everything, right? Just go flat. And the reason you would do that is because you get out of a first in, first out scenario, meaning that the first order you shorted is first out, right? So if I sell, let's say I sold 2, I sold 1 below bar 4, and then I sold another one at that little trap high from bar 3, well, that means that my average is right in the middle. And if I were to exit 2 at that earlier entry point on bar 3 for the shorts, so I look to exit everything here. First in, first out means that my original entry point is break even, and my second one turns a very nice profit. And you gotta believe that a lot of sellers are going to be looking to lock in break even because they don't want this to go negative again. They're trying to milk it for what they can But if it doesn't want to go, they're not going to hang on too long. Go to the next candle, and it goes down and hits that just above that support level. And that's really important, okay? Because if the sellers didn't exit, right? If the sellers did not exit, put yourself in the shoes now, right? We know that the buyers got really nervous here, and then it finally came back and threw them a bone. Now put yourself in the shoes of sitting negative, adding more, now you're back negative again, and it came one tick away from your break-even point, right? Put yourself in that psychological sentence where you're just like, oh, no, right? No. It came one tick away from my exit. I would have turned a really nice profit and gotten out of this crap hole of a trade, and now I'm sitting negative on both contracts, and it missed me by a tick. That's going to get a lot of people upset, and if it goes above that bull bar, you better believe, I don't care if it's a range, you're probably going to see a breakout move, because all of the sellers who were trying to get that flush, they did not get it, and now they're sitting on the back burner, right? So because they're on the back foot and they're looking to try to get out, that would be a buy signal for buyers to try to trigger back up for a scalp there as well. There's your breakout. All the sellers exited above that bull bar. They did not want it anymore. Now, the nice thing is, because they added in at the highs, they mitigated their loss a little bit, but for the most part, they probably got out pretty much break even on the first one and ended up just taking the loss on the second one anyway, because that entry point above that bull bar is basically right back at their break even of that trade. So, breakout move to the upside, beautiful continuation higher, but what do we know? This is a range. This is a range-bound environment, and a strong breakout almost never going to succeed. Got an 80% failure rate on that candle right there being able to stay up here. Sellers will sell the close of this bull bar, as well as the buyers who bought above that bull bar looking for a push to the high of day, they're exiting as well. So everybody that's pushing the market up is getting the heck out of the way. Next candle, right back down again. What a surprise, right? Would have never guessed that it was going to come back down. Now, this is where things get a little bit tricky, because when you're fading a range, you want to get as close to the edges of those ranges as you can. Sell high, buy low, stay the heck out of the middle. In this bear bar, you're essentially entering short right in the middle of the range. That's a terrible entry point, right? That's not something that I think a lot of wise traders are going to take, but a lot of rookie traders will. You got to be real careful in these situations, because if I were a trader in this environment, I would be looking to fade that short. I would have a buy order underneath that bear bar because I do not believe it, okay? So that's what I'm thinking here. I'm thinking, okay, this move you're selling halfway into the range. It's a mean reversion. You're basically selling into the VWAP during a range day. It's a terrible spot to sell, which means that it's a good spot to buy. Oh, next candle doesn't trigger it in. So we get an inside bear bar and now a micro triple bottom. And I say triple bottom because the low of that bull bar is the same price. There is obviously something here. So this is something that I want to be paying attention to, right? We're in an area of interest. We're at a micro triple bottom. We know that there are going to be buyers underneath this lows, and there are going to be weak sellers underneath those lows, hoping that it goes further. So this becomes a real big area of interest. Oh, and there we go. It triggers in the sellers, and honestly, if the sellers were fast enough, they would have been able to get a scalp out of that. But it also triggers in the buyers, and we can see who won that battle, spiking all the way back to the upside. So, beautiful buying opportunity, trapping in those sellers, not believing them in a range day. And it just actually gave the sellers, even though it was low probability, still gave the sellers a really nice scalp if they were quick enough. Just goes to show you that just because the trade doesn't necessarily work in hindsight, could have still got something out of it. Both sides can be a winner in this game. Now, here again, what did we just talk about? A strong bull breakout in a range. What are the odds of success on that? I'll give you a second to pause the video. What are the odds of success on this candle sticking? Done with the pause? Okay, so that is about 80% failure rate, right? Whoa, wow, it's like we just talked about that. So we know that this move up is very not likely to really stick around. But there is a little bit of a caveat here. This is off the backs of sellers getting trapped in, and they were able to get a profit target out, which means those sellers are gone. So the sellers that would be holding the market down and looking to potentially sell more if it goes higher, they're not there because they got scalped out, right? They got lucky, I'll give them that, but they got scalped out of the short, which means that there is a chance that this bull bar goes a little bit higher up, which means that instead of an 80% failure rate, I have to bump it back a little bit more to maybe 65 or 60. There is a chance that buyers can get a breakaway move maybe to fill the gap. So I don't necessarily think selling this candle yet is the best strategy unless you're really aggressive or if you have a larger account that you can build into a position with. It does go a little bit further, but we have a weak bear bar. Weak bear bar doesn't really prove a whole lot. Maybe there's sellers there, maybe not. Again, I think a lot of sellers are waiting a little bit, like, yeah, we just came off of a pretty strong double bottom on those wicks. We know that there aren't many sellers left in the market, and now we're seeing a weak sell bar. Probably not a whole lot of sellers in the market, right? So we need to wait. We get a strong bear breakdown candle. Okay, now we're starting to see the sellers coming back in. Maybe I was wrong by skipping that bull bar sell, right? That could be the case. Am I going to sell underneath this candle? No. The exact same reason why we talked about not wanting to sell below the bear bars earlier. Now you have to picture the range like this, right? This is the overall range. You're selling right there. It's about 50% of the range. There's no way I want to sell that, which means that it's probably a good buying opportunity again. So buying underneath that bear bar makes a lot of sense to see it try to turn back higher again. Buyers buy underneath the bull bar, pops right back up, and that's exactly what we expected, right? This is what we want to see. Now, if this bull bar, which is very weak, does not show continuation, all of the sellers who waited to get in on that big bull bar, they may have sell orders that are pending right there. You'll notice they would have gotten filled. So sellers jumped back in that area. Otherwise, a lot of traders are going to be looking at this bull bar saying, what the heck is this, right? What is this crappy bull bar? The sellers are stuck. You bought against it for a potential scalp. That would have worked out nicely. But now, our buyer, if I was a buyer, would I want to buy above that bull bar? It's not a chance, right? That looks awful. There's nothing about that I want to buy into. So I need to give it a little bit more time. What happens? Strong bear bar. Again, same problem. You're selling about halfway into the range. I don't really like that. But now we have weakness on the bull bar. We have sellers trying to come in. If it wants to come back up to that original entry point, I don't necessarily mind looking for a sell there. If it comes to a new high, I would love to see a sell there as well. That gives you an even better price, right? So looking to sell those two areas now, if it does come back, I think makes a lot of sense. So I'm going to bump the resistance up to that entry point right there. I'm going to get rid of the swing low. That's pretty much done and gone. We'll get rid of these guys because we know they're gone, and we'll leave the rest down there. So this one right here, this is the area of interest for a possible short. Make it orange. As well as a new high above the range, because again, it's a range day, a breakout, probably not going to be successful. So we get a little bit more. Bears do end up selling underneath that bear bar and showing continuation. There's a chance that by being a little bit more conservative and waiting for those limit orders, you might not get filled, right? You might miss this trade. There is nothing wrong with that, okay? Because you're sticking to the plan, right? You're staying with it and saying, okay, this is a range. It's failed on a lot of different ends. I would much rather look to fade when we're higher in price rather than trying to get in underneath a bear bar in the middle of a range. It just doesn't make sense. I am totally fine if this doesn't come back and get me because I followed my plan. I did exactly what I'm supposed to do. So let's wait. Oh, and it came back and gives you the fill right there at 12 and, 12 and a quarter. So it pops back up. It gives you the fill at 12 and a quarter. Now, this is a very unique situation because this is a low probability sell given the distance of the stop. Sellers will be selling here, but they do not want to see the highs break, right? Look at the size of the stop here. We're looking at a very, very tiny stop. But what's the objective? The risk reward on this trade is obscene, right? Because we're looking back down to where? Well, where was the last time we found support? Guess what? Right there. So we're looking at like a 2.5 to 1, 3 to 1 risk reward to the downside and potentially even further. Because of the fact that we're cycling off the highs of a range, it has a 3 push wedge top that has now failed, and we haven't seen a swing low broken yet. So objectives are going to be swing lows on the way down and potentially a full cycle all the way back down to a new low of day. But either way, we know that sellers are in and stops are above the highs. Oof. Oof. Oh, that sell bar. Those sellers are happy, right? They sold that high. They had a real tiny stop, and look at the move down. They would have been able to get filled at structure. They would have been able to get filled at the double bottom because it went through that. They are very, very happy. Now, this goes off the backs of maximizing profit. Again, another video that we posted on YouTube. Feel free to watch that one as well, because we know that the job of the sellers isn't just to exit and say, okay, got my entry, got my stop, we're at a 3 to 1, I'm just going to hit the exits. No. Right? Now, we do know that a very strong bar in a range is probably going to get faded, but we have to keep things in context. The buyers just put in a 3 push wedge top. The buyers failed multiple times. It came back to get those buyers. If you were a buyer above that giant bull bar, it came back to get you out 1, 2, 3, 4 times. A lot of those buyers probably gone. which means that if the buyers are gone, it's the same situation that we saw in that bull bar, what we were talking about. There is not an 80% chance of failure, there's only a 60% chance of failure. And we already know that the low probability scenario is working, right? The sellers had a real tiny stop. Probability of success on that, like 30% if you're lucky. It's working, right? So the market is taking the low probability approach. And when the market chooses a low probability route or path to follow, it usually means that it's going to get a secondary leg. So there is a good 40% chance that this bear bar continues. So we don't necessarily want to exit yet, but we also don't want this to turn into a loss. And that means that if this bear bar's high breaks, that is a problem, and all of the sellers who are in this, their stops are going to be right there. It kind of sucks for right now because it is pretty far away, but you've locked out all the risk. You're at a 1-to-1 actual risk based on what you had to risk for your original stop. Everything's pretty hunky-dory. Just let the trade give it some time, see if we can maximize this a little bit. You get another bear bar down, but weak, right? It's a weak bear bar, could not close underneath, and now we're seeing support coming back in again, right? Support coming back in at 29.08. This might be a problem, right? We do not want to see support coming in here. That's an issue. So sellers not necessarily will lock their stop down underneath this because now you're just begging to get whipped out. But what you will do instead is put your stop back a little ways because the VWAP is in the middle. Remember, mean reversion. When we have a mean reversion scenario, putting your stop directly on top of the mean, you're probably going to get tapped out, right? That's just kind of how math works. So instead, I don't think you do anything. If you're going to do something, maybe move the stop down a little bit, but the safest place is still a stop above this bear bar at your 1-to-1, right? So worst case, you still made your 1-to-1 on the trade. Might not be worth a whole lot, but you still made your 1-to-1. Let's give it a little bit more time here. If we get a bull bar that closes above that bear bar, that's a problem, and that is a sign to get the heck out, right? Oh, and we have a beautiful bear bar, and hey, what do you know? If you would have put your stop at the mean reversion, you would have been tapped out. Weird, right? It's almost like this is a range environment. So that's why you need to be paying attention to where not only where you're putting your targets and stops and probabilities and such, but also in the middle of a trade, if you're trying to maximize your profit, getting too aggressive will just get you tapped out. You got to give the market some space, especially in a range when it's away from the average. It's going to come back to the average. And that's exactly what we saw here. Now, we do have a different situation. We have an engulfing bear bar, or a near engulfing bear bar, back down to the lows, closing on top of support that just whipped out a lot of people. If the high of that breaks, there is nothing I want to do with it, right? Just get me out. I do not want it. Objective is a new low of day, but again, we're trying to maximize as much as we can on this so that we can, try to get a little extra juice out of it. So stop is now above this bear bar's high because you do not want to see that trigger, and that means that if it does trigger, you're going to have buyers that come in there, right? That's a possible long scalping opportunity. And it continues down. Oh, beautiful. Okay, so now we're breaking down to a new low of day. We're breaking down to a new low of day. I do not want to see the high of this bar broken. And the reason being is because now we're in a situation of a twin reversal. This goes down, it could easily come back up just as quickly and reverse back up. Remember, we're dealing with a range. So your stop immediately locks down, right? Now you've locked in basically what you were looking for in the first place, a little bit extra. And now we're still in the trade. We're giving it that chance, just like we talked about in maximizing your profits in that video. So let's keep it going, see if it'll go a little bit further. Okay, now we're coming down to the 200 period moving average, and we're showing some support coming in off of previous structure. And guess what? This is likely going to be about a measured move if you were to look on a 1-minute chart. We're in a lot of levels of support. If the high of this bear bar breaks, I am not interested, and the chance of it breaking is pretty high right now. There's a good chance that that does end up breaking. So locking a stop down here is one option, or simply just exiting the trade, saying, you know what, just get me out. There's a good chance that I'm going to get whipped out anyway. I might as well just take it where it is. Of course, you have to have a little bit of experience to understand when that point is. And for me, I still would rather try to maximize as much as I can because the markets, you never do know. They might go a little bit crazy. So very nice move to the downside. The stop moves in over top of that bear bar because if it triggers, there's a problem. And that means that buyers might even try coming in there, especially the fact that we're coming into structural support. We're at the range lows and we're at the 200 period moving average. There may be some buyers there. Alternatively, I think a better way if I wanted to be a buyer would be let that trigger and then buy a retest of support. That would make a lot more sense. And there we have them triggered out, right? So the sellers that were in the move, they were trailing it down, maximizing their profit. They got a heck of a payday on that one, and it does end up tapping them out. Now, does that mean that it's just going to go flying higher or go back down? It could. It's about a 50-50 right now. Probability does lie with the fact that this range breakdown fails, but we know that this leg down is very strong, and the market has been choosing the low probability route. You got to be careful, right? Give it a little bit more time, or after a trade like that, just call it a day. Right? Now we are going into, what time is this candle? 11:30. I'm usually done by this point, so I'm not trading really, but just kind of going a little bit further. We can see that buyers will be buying into right there. Right? The stops got triggered out. Our job is to get in as low as possible, or at least as low as we think we can, and structural support makes a whole lot of sense. So now buyers, we know, are in. Sellers are probably out, which means that there's not a whole lot of sell pressure left to keep it going. And in a range of failure back up does make a lot of sense. They may try to reach out and test the lows one more time, though. Ends up as just a giant doji. Okay. Well, if you needed a signal to maybe be a little bit concerned, a humongous doji after testing this level of support might give it to you. So not really anything that we can do there. And now we're starting to get a little bit of a bull lift up. That looks good. Buyers will be buying into that retest. You probably could scalp out at this point, looking for a retest of the next structural level right there. But you get the idea, right? And there's that scalp move, and now just kind of ping pong. Oh, and that's the current candle. So beautiful movement on the S&P. And when you look at a market and it's super range bound like that, don't immediately assume, it's just noise. It's a lot more than just noise. There's a lot going on behind the scenes, and there's a reason that each one of these candles is still pushing 30,000 contracts traded, because people are still seeing value, even if it doesn't necessarily look like it. So hopefully you learned something. Hopefully you found it interesting. I know we don't do these a ton, but that's because they take a half hour to do. But it's a great learning experience. And if you haven't gone through your charts in this manner, I highly, highly recommend it. Mark up where you'd look to go short. Mark up where you'd look to go long. Mark up what you think is happening. Write notes along the way. Don't cheat. Set that right side margin really far and go candle by candle by candle. It's a really great way to get in the mindset of how the markets are moving. So again, I hope you learned something. I hope you found it interesting. It's a great way to review your trades, or the trades that you maybe missed or did take, and just a good idea and a good way to get the feel for the markets. Underneath the video, make sure to click on subscribe, give me a thumbs up, and also click on the notification bell icon of the subscribe button so you are notified every time these videos comes out, because there are a lot of videos, and a lot of them are might be biased, but I think they're pretty good. So that's going to do it for this one. I hope you had a fantastic trading day today. If you have any questions, feel free to send me an email, jbrink@slingshotfutures.com. Until the next one, going into the holiday weekend, I hope you have a fantastic holiday as well. Spend some time with family, and we'll see you all back on Tuesday. Have a good one. We'll talk to you all later. Thanks.